Hello and welcome to the second video of the Tax Foundation State Tax Policy Bootcamp 2026. I'm Jared Walczak, a senior fellow at the Tax Foundation, and today we're talking about corporate income taxes. The corporate income tax is an important tax, but it has historically been one of the smaller of what we think of as the major taxes within state tax systems. Historically, it has generated about 5% of state tax revenue, about 2% of overall general revenue for the state. Now, in recent years, it's been a bit higher. Corporate receipts have been high. Corporate tax collections have been higher as well. So in the last couple of years, we've seen revenues perhaps as high as 5% of state revenues, but historically lower than that. Still, nonetheless, a very important tax, both because of the unique structure of it, how significant it can be for state tax competitiveness, and the many debates around corporate income tax. So today we're going to spend some time walking through just what are corporate income taxes? How are they imposed? How do states determine what corporate activity for a multi-state business is subject to that state's tax? All of the determinations that go into what is subject to tax. How do you determine that tax base for a business? We're going to go through all of that, as well as some of the economic literature and some of the considerations surrounding corporate income tax. Corporate income taxes across the country vary dramatically in terms of rate. You can see that they range from 2% in North Carolina, a state that is working on phasing out its corporate income tax entirely, to 11.5% in New Jersey. And in some cases, you can even see higher rates in the rare instances where there are local level corporate income taxes. So New York City, for instance, you can get, at least on the activity within New York City, a rate of over 18%. And we're going to talk in a little while what it means to have activity for corporate income tax purposes within a particular jurisdiction. Now, there are some states that have no corporate income tax. Most of these do have some other form of business tax, a gross receipts tax. So you look at, say, Texas, Washington, Ohio, they have gross receipts taxes in lieu of a corporate income tax. But Wyoming and South Dakota have no major business tax, no corporate income tax, no gross receipts tax. Everyone else has one. So this is a tax that in most of your states is clearly significant, clearly something that generates a lot of interest in state capitals from year to year. With corporate income taxes, at some level, we know who pays. The corporation pays. That's the legal incidence. C corporations are remitting corporate income tax. Now, it's important here to mention this is just C corporations. Most businesses in this country are what are called pass-through businesses. They are owned by a smaller number of shareholders. It might be a single owner. It might be a small number of owners. And their structure is such that the income flows through or passes through, as the name implies, to those owners on their individual income tax returns. So when you think about S corporations, partnerships, LLCs, sole proprietorships, these are not corporate taxpayers. They are not paying the corporate income tax. The owners are paying individual income tax when that business income flows to them in their individual returns. The corporate income tax is therefore on a really small number of businesses, but they are in many cases some of the largest businesses in this country. It's not always true. There are very small C corporations. There are some pretty large S corporations, but C corporations employ about half of all employees in the country, even though they're a small share of the overall number of companies, so significant. And we know, of course, at the entity level, corporations are paying corporate income tax. That's that legal incidence. But economists care about economic incidence. And lawmakers need to care about that as well, because when you're imposing this tax, it doesn't just matter who is writing a check. It matters who is bearing a burden. And that economic incidence of the corporate income tax is going to be borne across three different types of taxpayers. It's going to be borne by the shareholders in the returns of lower returns. That capital investment is being taxed. It's going to be borne by workers in the form of lower wages than there would be without a corporate income tax. And it's going to be borne by consumers in the form of higher prices on the goods and services they purchase. There's controversy on this. There are a lot of studies trying to determine exactly how that incidence breaks down. And they don't all agree. There are a variety of different approaches to addressing this. Some research suggests that the incidence is primarily on shareholders and workers and only to a much lesser extent on consumers. A rising literature is actually strongly suggesting that much of the burden, especially the way that corporate income taxes at the state level are now imposed, is ultimately on consumers. And there are some reasons to believe that state level corporate income taxes are more of a tax on consumers than federal level corporate income taxes are based on the way they're designed. We'll spend some more time on that. What's important to know here is that there is not complete agreement on how this breaks out, but there is certainly agreement that the economic incidence is dramatically different than the legal incidence. You have studies that suggest about a one-third split, that it splits about evenly, shareholders, workers, consumers. You have a number of studies that see it more like 50% on workers and the rest on some combination of shareholders and consumers. And like I said, there's a rising literature suggesting that at least at the state level, it's actually much more passed along to consumers themselves, that they are bearing much of the burden in the form of higher prices. So, as lawmakers consider corporate income taxes, understanding who ultimately pays is very important, and understanding why we have this tax, if indeed we should have this tax, and what it means to make changes to this tax. Now, the corporate income tax is, in most states, based substantially on the federal corporate income tax. And this makes a lot of sense. You don't want to reinvent the wheel. The federal government levies a corporate income tax. States generally are going to conform to most of the provisions of that tax. They are going to use, for the most part, the same definitions of income. They are going to rely on the same rules, guidance, regulations. If there's a court ruling about some important issue, they're most likely to bring that in. And all of that requires there to be conformity to the federal corporate income tax. And that conformity can come in a number of forms. Some states have what's called rolling conformity. Whatever the current federal code says, they do the same, except where they expressly make a modification. Other states have static conformity, where they are using a version of the Federal Internal Revenue Code as of a particular year, and lawmakers have to come back from time to time to update that to bring the code up to date. This can be very significant. When states get a few years out of date, it creates challenges. Businesses paying in multiple states don't necessarily have the same rules to work with, the same definitions to work with, the same application of court decisions and of regulatory guidance. These can vary across states, and you have to back out and treat things differently. It creates a lot of complexity. It creates more tax controversy. It's what creates the administrative and compliance nightmares that hurt both taxpayers and the tax administrators, the state government itself. So most states like to be up to date on conformity if possible, but some fall behind. Every state makes some modifications, and we're going to talk about this some as we talk about how you define the corporate tax base. But it's worth saying here, no one does exactly what the federal government does in every particular. Every state is making certain modifications to what's deductible, what counts as taxable income, how you treat certain expenses, lots of different provisions. And of course, states are often going their own way on offering certain incentives and preferences. Every state has their own tax. And clearly, every state imposes its own rate. That is not something that flows through from the federal government. But that base, at least as a starting point, states are starting generally with a federal starting point of corporate taxable income with selective decoupling and modification to certain provisions. So let's think now about that corporate income tax base. It's worth understanding initially what we're trying to tax when a state imposes a corporate income tax. The corporate income tax is on net income, which is to say profits, or at least that's the goal. And therefore, you can't just tax all income. If you tax gross revenue, you have a gross receipts tax. You'd be taxing something that is vastly above profits. You need to be able to back out the business expenses. And this is where a lot of ordinary deductions come in. And it's important to understand that these are not preferences, these are not incentives, these are not handouts to business. These are definitional terms to try to address how you get to the calculation of net income. So firstly, of course, you need to allow some sort of deduction for ordinary business expenses. Just the day-to-day expenses of doing business. You need to have a deduction for the cost of goods sold. Essentially, if you are purchasing a good that you are going to sell down the line in some form, the acquisition cost of that good is not profit. It is an expense. Compensation, the wages and other compensation you pay to employees, that is clearly something that needs to be deducted out. You have a variety of other things. If there's dividends between corporations, you need to make an adjustment for those. When you make capital investments, and we'll talk a little more about this in a minute, but when you purchase machinery or equipment or building structures, when you invest in research and development, all of these are costs. You hope, of course, they are going to produce profits down the line, but they are costs and they need to be deducted to get to a definition of profits. Now, what we're going to see is that states tend to treat capital expenditures differently than current expenses. Many states, in a variety of ways, require those deductions to be taken over time rather than as immediate cost recovery, where they are just expensed in the year in which that expense is attained. But you have all of these deductions just as ways to address getting to profitability itself. So you get a proper tax base for a corporate net income tax. This also requires dealing with net operating losses. Businesses have profits in some years and losses in others. And when there are losses, of course, there's no corporate income tax burden, at least if you're defining the base correctly, because you don't have net income. But those losses could be substantial. And then in future years, when there's profits, of course, for the business, you're recovering. If you're thinking over a longer time horizon, those profits and losses are offsetting each other. But for tax purposes, we have to choose some sort of timeline in which to tax. You have a taxable year. So if you have losses in year one, profits in year two, if you're taxing and you have no tax in year one, tax in year two, not adjusting for the losses, you're overtaxing. Every state recognizes this. Federal government recognizes this. Basically, every corporate income tax regime in the world recognizes this is a problem you need to address. So they use what are called net operating loss carry-forward provisions. This allows you to carry the losses forward in some way so that they essentially reduce profitability in future years to smooth over your profits and get to that true definition of profits. But states vary in how they do this. The federal government allows unlimited years of carry forwards. You can carry forward those losses as long as you need to fully cover. However, they only allow you to use them up to 80% of a reduction in taxable income in a future year. So you can't go down to zero in a future year with profits. You need to keep carrying them forward. Some states do that. Some states allow all of it to be used up to the point of taxability, but they may cap it on number of years, for instance, 20 years. There are a few states that are much more restrictive, that only allow this to be carried forward for a small number of years, where you may not be able to use all of those losses, or they have stricter caps on utilization. And that's something that can be very distortionary. It can harm businesses that have more cyclical business income. It can harm businesses that might be trying to recover from a longer period of unprofitability. It can essentially hammer businesses while they're down and prevent them from recovering. So the federal government offers a model. Most states either have that or something that's about similarly generous, but there are a few states that are outliers in this. Corporate tax bases also have to deal with deductions for interest. And the federal government and most states have some limitations on how deductible interest is, though you always have some deduction or interest. And then there's further adjustments, and we'll talk about some of these later, but you have adjustments for credits and incentives. So most states are offering some economic development incentives. These are going to be credits that reduce liability, often dollar for dollar, and even refundable so that it can reduce liability to the point where you actually get a check theoretically. This is obviously a controversial provision. We'll talk about that later. There have to be provisions dealing with foreign income and how you treat that. We'll also talk about that. There's a lot of things we're going to get into, but the basic point here is that you have to include a lot of deductions, not to offer special preferences, but just to get to what is that base? How do we define corporate net income? How do we define profits? One of the key provisions I mentioned previously is the way that states treat capital investment. So when a business invests in machinery or equipment or other capital assets, historically, states and the federal government have required the deduction to be according to depreciation schedules. Now, depreciation makes perfect sense from an accounting standpoint. If you purchase $1 million piece of equipment, you are not $1 million poorer. You've exchanged financial assets for a physical asset, a productive capital asset. So you've just exchanged one form of something worth $1 million for something else worth $1 million. And of course, that asset will lose value over time. It depreciates. That's why accounting has depreciation rules. But that's not really appropriate for corporate income taxes, because corporate income taxes are not measuring the value of your assets, which didn't fundamentally change. They're trying to figure out your profits, your net income. That business expense is never part of your profits. So it doesn't make sense that we would only allow this deduction over time. And in fact, when it's only allowed over these depreciation schedules that can run, 5, 10, 15, 39 years for some, especially for structures, this is a disincentive to invest. It is essentially shifting costs where you're saying businesses now have to incur an inflation penalty. They have to bear the time value of money. And also, if a business has cash flow issues, we are overvaluing their profits now when they might not have the ability to pay or might cut more deeply into them while they're growing. So it's largely a timing shift. The deduction is offered in every state, but it's a question of when that deduction is offered. And when states choose to use depreciation schedules, they're discriminating against, they're penalizing capital investment, which is usually something states don't want to do. So at the federal level, we now have what's called full expensing for machinery and equipment purchases. This is something that had been phased in over time. There was bonus depreciation, a terrible term, but a term for allowing additional first-year deductions, sort of 100%. Then under the Tax Cuts and Jobs Act, it was temporarily made 100% first-year expensing, started to phase out again. Now it's permanent again. And a fair number of states, as you can see on the screen, conform to this provision. It's in 168K of the Internal Revenue Code. They allow the full immediate expensing of machinery and equipment purchases. When businesses make them, you don't have to depreciate them. You get that deduction now. That's good. It's pro-growth policy. It's really appropriately getting to that definition of taxable income. Again, not every state does this. There are quite a few states that fall short of this, that do not conform to this provision. And we'll see as well that there are other ways that this can also apply in other forms of capital investment. For instance, until very recently, every state and the federal government allowed an immediate deduction, full first-year cost recovery for research and development expenses, or the term of art that is used at the federal level and in most states, research and experimentation expenses. Same thing. But basically, this was always something that had been allowed as a first-year deduction. But as a gimmicky pay for in some previous legislation at the federal level, there was an expiration of that. It turned into a 5-year amortization. Congress probably never expected this to actually go into effect. It was in the out years. It was supposed to be fixed. It was not fixed until more recently. It was fixed as part of the Reconciliation Act in 2025, H.R. 1. And now states are deciding whether they're going to reconform to that provision. They all had it previously. For decades, everyone did this. But now it's an open question, and some states are choosing to decouple from that provision or to temporarily do so. I think it's just important to recognize from the Eisenhower administration until 2021, inclusive, this was a provision that any state with a corporate income tax and the federal government had because it made perfect sense. But right now it's this open debate on, do you want to treat research and development expenses as an expense, or do you want to put a little bit of a tax penalty on them? And again, most states historically have not wanted to penalize capital investment. They've recognized that it has positive externalities, that in fact, when businesses engage in research and development, they are creating innovations that don't just benefit them and their shareholders, but have spillover effects that benefit other businesses, that benefit the public more broadly, that this is how you grow economically, is by doing this basic research that opens new horizons. So a lot of states, of course, have special incentives for R&D. That's not what we're talking about here, but we are talking about how do states treat just the ordinary expense of doing that? And, we would certainly hope that states get back to the treatment that they already had. And then there's international income provisions. And this is relatively new. States historically did not attempt to tax international income, but with changes to federal law beginning in 2017, the federal government actually reduced its taxation of international income. It went from what had been called a worldwide tax system to a territorial one where it's really focused on activity within the United States. But in the process, the federal government created certain guardrails to avoid profit shifting, where intellectual property, we're thinking things like trademarks, copyrights, various things that generate royalty income, would be placed in a low tax regime abroad, and all the profits would be shifted there to avoid taxation. Congress didn't want that to happen for understandable reasons. They put in guardrails. And those guardrails then got adopted by states in ways that didn't fully make sense. So some states started taxing a share of international income that really didn't belong to them, never made a lot of sense within their regimes. And then, as part of H.R. 1 in 2025, the system changed again. And now we have essentially a corporate international minimum tax. It's called the NECTI or NICTI, you can call it what you want, the tax on net CFC tested income. We're not going to go into all of the weeds here. A CFC, by the way, is a controlled foreign corporation. Think of it as a foreign subsidiary of a U.S. parent company. But essentially, at the federal level, if that subsidiary pays very low taxes abroad, it pays the difference up to roughly 15% in tax to the United States. But they use foreign tax credits, the credits for taxes you paid abroad, to essentially reduce your liability, potentially bring it to zero at the federal level, provided you paid taxes elsewhere. States don't have that piece. States don't offer foreign tax credits. So therefore, the states that conform to this provision are not taxing low or untaxed income abroad. They're not taxing some sort of profit shifting. Any business that does any business in their state that also has any international business or has subsidiaries or affiliates or related companies with international business, some share of all of those international profits is being brought into the state and taxed for really no particular reason. It doesn't have anything to do with how much it's taxed abroad, whether the activity had anything to do with the United States. It's being taxed in these states. And this is, I think, inequitable, but even more importantly, as we talk about the effects of corporate income taxes and how it can have a flow through on, say, the price of goods in the United States, in fact, where the destination of that tax is, you might say, hey, we're taxing international stuff. This is free money. There's really good reason to believe you're actually driving up the prices within your own state by doing this. So it can be backfiring, even though it can seem like free money from abroad. Of course, to understand any of this, we need to ask, how do states determine what income they can tax? When you have a multi-state or a multinational business, it's not easy to say how much of the operations are in my state versus another state. So there's several threshold questions that have to be answered. The first is called Nexus. This is about establishing the connection between a business and a taxing state. There are constitutional requirements here under the Due Process and Commerce Clause requirements in the United States Constitution. You have to have some minimum connection with the state, a sufficient relationship. And that's what we mean by nexus. It's a definite link, there's a business to a state. And there are constitutional rules, there's statutory rules. There's a federal statute, PL 86-272, that imposes some specific restrictions. It says for businesses that only have solicitation of sales in a state, that's not sufficient to attach nexus. So think of this perhaps as a regional manufacturer, and they sell their products maybe to distributors and to other sellers in other states, but they're not actually doing business directly in those states. That is not sufficient for them to have nexus in those other states. But in other cases, economic nexus is sufficient. You don't need to be physically present in the state to have nexus with them. And then depending on the structure, we'll talk about some other provisions later, particularly around what's called combined reporting. There's affiliate nexus, the activities of your related entities or your facilitators, they can create nexus as well. And then apportionment. So once you determine is the state allowed to tax something, apportionment answers the question, how much can you tax? It's trying to determine the share of business income subject to a state's tax. Historically, there have been three factors that have been used to determine this under what's called formulary apportionment. These are payroll, property, and sales. So traditionally, it was evenly weighted three-factor apportionment. You said, what percentage of the company's overall payroll is in my state? What percentage of its property? What percentage of its sales? You add all of this up and you say, hey, 15% of this is in my state. We can tax 15% of the company's overall profits. We don't have to figure out where exactly did the profits come from. We just tax that share. Over time, most states have shifted to what's called single sales factor apportionment. They are only focused on where the sales take place, not where the payroll or the property is. Now, the rationale for this is largely an economic incentive one, that if you're taxing payroll and if you're taxing property, you are taxing the decision of businesses to locate in your state, to invest in your state, to have employees in your state and assets there. And states don't want to do that. So they've stepped away from that and they've said, we're going to tax using our market, selling into our state. Just base this on if you have 10% of your sales in our state, well, then we're taxing 10% of your profits. Even determining how much of a sale is into a state is not necessarily easy. With tangible goods, physical things, it's not so hard. Something's there or it isn't. But with services, where is it? That's actually fairly complex. There are many sourcing rules that states use to determine where the benefit of a service is received. But there's actually even a threshold question here. Do we start with where the service originates from or where it is received? So some states use what's called cost of performance sourcing. They say wherever the service is performed is where we source it. And that's really antithetical to the notion of sales factor because a sale is received somewhere. It's destination based. So going backwards to where was it produced is not really consistent with sales factor. It feels a lot more like payroll factor. states use what's called market sourcing or market-based sourcing. This is where is the benefit of that service received? So you purchase a service, someone in state A is helping facilitate that, but you in state B are getting the benefit. Well, that's where the sales factor apportionment takes place. Now, because not every business has Nexus in every state, you have the potential to be selling into a state, not have Nexus with it, and therefore there's no income to apportion there because you don't have Nexus. Some states have felt, well, then not 100% of activities being taxed. We should do something about this. We should adopt what are called throwback or throw rules. We're going to get into these separately in a moment, but essentially the idea is to try to capture some of that. What's important here is to note that under formulary apportionment, you can both have under taxation with what's called nowhere income, where it's not taxed in any state. This can be because of a lack of nexus somewhere. It could also be because the apportionment rules of different states just differ in such a way as to undertax activity. It can also happen, though, and in fact, more often happens, that you overtax activity. If, for instance, you are in a three-factor state, selling into a single sales factor state, the three-factor state is going to tax you based on the fact that you have payroll and property there. The single sales factor state is going to tax you based on the fact that you sold into that state. It will lead to double taxation. And this is actually perfectly constitutional, according to the U.S. Supreme Court. There are requirements around what states can and cannot do. There has to be what's called internal and external consistency. And the internal consistency test, which is relevant here, basically asks the question, if every state adopted the same set of rules, would it result in double taxation? If the answer is no, at least for that purpose, you're okay. Of course, every state doesn't have the same set of rules, so in the real world, this can lead to double taxation. Like I said, in most cases, states have gone to single sales factor, but we do have some states that still have industry-specific rules, where they say most businesses are under single sales factor, but for a certain set of industries, you're under three-factor, or you're under double-weighted sales factor, or under some other treatment. I would say it should pick one. You can choose three-factor. There's a case for three-factor. If you're thinking about what are the costs to a state that you might try to recoup with a corporate income tax, it's going to be where there's payroll and property. That's where states actually have costs that they incur in providing services to individuals and businesses. Most states have gone to sales factor. We get it. We understand why states have done that. But pick a lane. Trying to have different provisions, different factors for different businesses just doesn't really work. So you can see on the map, again, that most states have gone to single sales factor. A few states are on double weighted, where sales is worth 50% and the others are worth 25% each. And three-factor is increasingly uncommon, and I suspect is going to become even less common in the future as we really get to a almost exclusively single sales factor environment. When businesses are taxed, we also have to determine what is the business. And that's actually not an easy question to answer. Many businesses, of course, the way we think of them as a single business, they may be a nest of businesses. There may be many subsidiaries of a parent company. There may be affiliates. How do you deal with these different business structures? And there's two basic filing methods that are used. One is separate entity, and the other is what's called unitary or combined reporting. Separate entity reporting, states calculate taxable income and apportionment of each company separately. They ignore the taxable income and the factors of subsidiaries and related entities. Tax departments can still make some adjustments. So if there's intercompany sales, for instance, they can apply what's called an arm's length price to that to say, this is what it would have been in the actual market, even if they didn't charge that business this amount. But for the most part, they're treating each company on its own and taxing it alone. The alternative to this is combined reporting, or mandatory unitary combined reporting, as it's often called. It ignores the formal corporate tax structure of the business and treats it as a unitary business. All the subsidiaries are treated as if they're just divisions or branches of the parent company. So intercorporate transactions just disappear. They're just truly inside this company. Income reported on the books of a subsidiary is added to the parent company. And then apportionment is calculated using all of the factors of all of the companies that are related. Now, this is not simple. You need to determine which businesses are part of the unitary group. And it's not just that they have some connection to each other. Usually there are different rules about certain levels of shared ownership, shared levels of control, that decisions flow from one to another. Not every state will necessarily agree that the exact same unitary group controls. So you might have a company with lots of subsidiaries, and some of them are in the unitary group in some states and not in the unitary group in other states. This means that implementation can be very difficult. It can blur the line between tax liabilities and where income is actually produced. Fundamentally, you may be sort of taxing the wrong income. When we think of subsidiaries that are doing entirely different things, selling different goods and services in different regions, different activities, different profit levels, mixing these all together and getting an average really tells you nothing about the activity in a particular state. So it's meant to solve some problems. So for instance, what if you had a subsidiary where a lot of your income producing activity takes place and another subsidiary that really doesn't generate a lot of income, but is serving the other in some capacity? Yeah, clearly states want to tax the one that's producing income. But on the flip side, you can have subsidiaries and other entities within a corporate structure that are just completely different. And you can be taxing potentially the wrong things at the wrong rate in the wrong state. So this has been a challenge, but many states do indeed have unitary combined reporting. It's become the most common structure. And then there's the question of, where does combined reporting end? At this point, every state has either, and then there's the question of, where does the unitary group end? At this point, every state either has what's called water's edge combination or has an optional but not mandatory worldwide combined reporting. So no state is requiring all of the foreign subsidiaries to be part of the unitary group. And there are really good reasons for this, because when you bring foreign companies in, there's a lot of different complexity associated with this. You need to comply with foreign records rules, which may not allow the sharing that's necessary for this to work. There are different accounting concepts, different depreciation rules. There's currency conversions. There's privacy requirements in other countries that just create a lot of challenges in being able to bring this in. And then fundamentally, there's a clash of systems. Every state in the US uses formulary apportionment, whether it's single sales factor or some other set of factors. This is how they calculate apportionment. Apportionment is not a thing in the same way in the rest of the world. They do separate accounting. They are looking at individual companies and they're determining what percentage of their activity is in the country. So the rules don't really work with each other. You would be double taxing in just about every instance when you are taxing with our system businesses that are separately being taxed under a completely different system. Now, some companies like worldwide combined reporting. Perhaps their profits are significantly lower abroad. Perhaps the way they operate, they either have the resources or they don't have the various compliance challenges that prevent them from bringing all this information together. For other companies, it's significant double taxation. It may be virtually impossible to comply with. So a mandatory system, which has been discussed in a number of states, just throws up all kinds of hurdles that would be very difficult for many businesses to clear, that would be very discriminatory against some businesses, and would be incredibly difficult to administer in any way. Now, it's not even obvious it raises revenue. This is also potentially true of combined reporting, because it depends on what's happening. You can have businesses abroad that have lower profit margins than in the United States, and you bring those in, you aggregate them, and the share of profits is lower. Whatever share you're taxing of that business, you're taxing less net income. If there's higher profits abroad, you win by taxing that. If there's lower profits abroad, you don't. And I think a lot of people just think, oh, there's more income, but apportionment still applies. You still have to say what percentage of sales were into our state of everything, whether it's at the water's edge or international. So the share of sales into your state is far lower if you bring in the international income. The benefit is if on that share, there's more net income, which may or may not be the case. I mentioned a few moments ago Throwback and Throwout rules. These are about instances where a business is not taxable in a state where they have activity. Now, I don't say they are not taxed. A state choosing not to impose a corporate income tax, or a state having incentives that wipe out a company's liability in that state, that's not what this is talking about. This is a nexus question. If a business doesn't have nexus with a certain state, and they're selling into that state, that creates nowhere income that's simply not taxed. Some states have tried to address that by saying, if you're selling from our state into another state, and that state can't tax it, we are going to throw back, as the name implies, throw back that into our own sales factor, into the numerator there, and tax it here. Throwout rules. Right now, really uncommon. That's Maine. It used to be a few other states. That instead excludes it from the denominator. It's like that sale didn't exist, as opposed to bringing it back in. But both of them are trying to tax in the state from which a transaction originates, something that cannot be taxed in the state where it ends up. The argument is that this yields 100% taxation rather than something less. The argument against is it makes the taxes in the origination state extremely high because you're bringing in all of this additional tax burden from essentially as if you're taxing multiple states in one state, and you could avoid all of it if that sale originated from another state. So there's a fair amount of evidence that throwback rules, even though they're intended as revenue generators, don't really work because the activity that would be taxed largely shifts out of state. That states over time are losing revenue from this. They generate some revenue from the rule from the companies that can't or don't leave, but most companies adapt to it. And in fact, they bring more activity out of state and therefore reduce general corporate income taxation and property taxes and other taxes that are paid by businesses. It's one of the rare provisions that potentially loses revenue even though it's trying to gain it. That's not something you're going to hear us say very often. Even poorly structured taxes usually generate revenue. This is one of those, it's not really clear that it does. But nonetheless, states do have this. And again, worth noting, this is trying to deal with nowhere income under taxation, but there are so many ways in which the corporate income tax yields over taxation, where in fact it is taxing more than 100% of corporate income. Now, I've mentioned that states are trying to figure a number of things out these days. They're trying to figure out, do they tax NICTI? They're trying to decide what they do around that R&E deduction. Here's something to consider. Corporate receipts are way up for a variety of reasons, just general economic growth, increased profitability for some C corporations, and I think especially a lot of the changes under the Tax Cuts and Jobs Act, which just generated more economic activity here, brought more back to the United States, and induced additional capital investment. We have just seen corporate receipts increase substantially. What's valuable to understand, at the federal level, the Tax Cuts and Jobs Act was a tax cut, but it wasn't just a rate cut. It was substantial base broadening. It was a lot of things that encourages businesses to reinvest in the United States. And then it was also a really substantial tax cut. The rate reductions did not flow through to the states. The base broadening did. So states saw significant increases in their tax revenue. And this is true even now with the adjustments under H.R. 1 or the One Big Beautiful Bill. It has some temporary timing effects where as some of these provisions like that R&E deduction come back in, there's a year or two of timing effect where a number of years or costs are all brought into 1 year. But over time, you get back to basically your old baseline. And what's important is you see on the screen, it's all way higher than post-Tax Cuts and Jobs Act. These are robust corporate tax revenues. So I think it's important to recognize as states are trying to grapple with some of these questions of, do we do this thing that maybe is kind of counterproductive, but do we need the revenue? That corporate tax revenues are really about as robust as they've been in an incredibly long time. In fact, for the past few years, corporate tax revenues have been higher than at any point since the enactment of 1980s legislation that fundamentally overhauled the tax code. And the reason that they've been lower since then is because that legislation encouraged businesses to become pass-throughs. So there were fewer corporate taxpayers. A lot of them were pass-throughs. This is the highest since then. States are in a really good position with their corporate taxes, even if they, as I think appropriately they should, maintain conformity with a number of these provisions. Now, as we close out our time on corporate income taxes, there are some questions that we haven't answered yet that I think make sense to answer here. And one of them is, what's the rationale for a corporate income tax? And it might seem like an odd question, like, why wouldn't we tax corporate income? Why would we want corporate income to go untaxed? But the reality, of course, is that it isn't untaxed. Whenever income is distributed as dividends or paid out in compensation, it is taxed. So why do we have corporate taxes? Should we have corporate taxes? Now, there's one rationale that essentially the corporate income tax protects and shelters the individual income tax because without it, theoretically, individuals might put a lot of their income into corporate structures, at least until they need it to try to shelter it. Not a lot of evidence that would happen, but at least it's a theoretical argument that has been advanced for corporate income taxes. I think a much more compelling rationale historically has been that the levies reimburse states for the cost of providing services to the business community. That while businesses are obviously very good for your state, they also impose costs like anyone imposes a cost by being there. So when you have facilities there, when you have employees there, there are costs that states incur. And the corporate income tax is trying to address the fact that if you're simply taxing the sales or if you're taxing the income of individuals, it's not necessarily in the right location. The problem is states have fundamentally undercut this argument by going to single sales factor, because if there is going to be a reimbursement for services, it's where you have payroll, it's where you have property. It is absolutely not where you have sales, but that's where states have largely gone. Then the final argument is that it's about progressivity, that it's about taxing investors, even if it's double taxation in some cases, even if it's not economically efficient. And I would argue it's very much not economically efficient, that it's just a way to tax capital investment. But that argument is substantially undercut by the fact that incidence studies have routinely shown that a significant share of the burden falls on workers and consumers. So it's not nearly as well targeted if that is indeed the goal. And then you just deal with the harm. We know from many studies that corporate income taxes are uniquely harmful to the economy. Studies routinely report that employment, wages, and establishments, number of businesses, have elasticities of 0.4 negative or more. And here, let me interpret that as elasticity is one of those words economists like to use. What's a negative 0.4 elasticity? It means that the number of corporate establishments, the amount paid in wages, the number of jobs declines by 0.4% for each 1 percentage point increase in the corporate rate. So, 40% reduction versus the 100% shift. Yeah, essentially, like for every point in the corporate income tax, you're getting 0.4% reduction in all of these things. That's substantial. That's significantly more than we see with other major taxes. And it's something that lawmakers need to grapple with as they impose corporate income taxes. They're also a pretty volatile tax. Profits obviously exist some years, don't exist in others. Like I said, they're fairly economically inefficient and they're non-neutral. They're an interesting tax. They are a tax that sometimes it's not clear exactly how much lawmakers have thought through some of the provisions. For instance, we have some states that have progressive corporate income taxes. And we can understand what the argument is for a progressive individual income tax. That higher earners, maybe some want them to pay higher shares of their income, not just a share of higher income on that tax. But what does that mean in a corporate context? The largest businesses in the world can have low-income shareholders. The smallest businesses sometimes have extremely wealthy owners. So you're not really capturing progressivity by having progressive rates. And I think that often some of these incongruities show up in corporate income taxes because they are complex. They are things that a lot of policymakers, a lot of people engaged in this process haven't thought through exactly what are we trying to accomplish with the corporate income tax. So it's a small tax in the grand scheme of things, but it's still a meaningful one because it has such a significant, I think, outsized economic impact. Hopefully, the discussion we've had today helps you to better understand what corporate income taxes are, how they work, how they apply, and some of the current issues that lawmakers are engaging on and need to engage on within this tax. As always, my colleagues and I at the Tax Foundation are available as a resource to policymakers across the country. We have lots of resources on our website, and we'd love to answer your questions. Thank you for taking time with us to learn a little in this bootcamp lesson about corporate income taxes.